This is Converge,
a podcast from Convera.
Come with us as we shape the future of finance. Welcome to another episode of Converge. I'm psyched to have Simon Taylor with us today. I'll let him introduce himself in a moment, but just to set the context here for today's episode, FinTech was definitely one of the sectors that saw a boom during the COVID years of 2020 to 2022. And with more time spent online, capital continuing to be cheap and plentiful during those times, FinTech challengers, which are sort of the subject for today, were really vibrant and grew a lot as they attempted to rethink the world of financial services and have many different new value propositions for this world. But things have changed rapidly in the last 18 months, and many small players have been going to the wall, while bigger, more established fintechs having to rein in their expectations as revenues and valuations plummeted from those record highs that we saw in years past. So I'm joined today by Simon Taylor of Sardine, whose weekly FinTech Brain Food newsletter has been cataloging sort of the ups and downs of the space for a number of years now. Welcome, Simon. Can you give, just for our listeners, a little bit of background on yourself, your role at Sardine, what Sardine is and their mission, technology, and then, of course, the newsletter, which we'll be talking about today?
Yeah, thanks so much for having me. Excited to be on the podcast with you guys. Short version for me, about 17, 18 years in financial services. I've worked in everything from payments, I've worked with banks, I've worked in fintech companies, for fintech companies, as a consultant, bit of a journeyman. And today I found myself at Sardine, who are the world's best fraud team that you hire as an API. Our mission is to get rid of scams, get rid of fraud, and make sure all of the people that are losing out with $10,000 lost, $20,000 lost, that shouldn't be happening to anybody. And we're here to put an end to that at Sardine. So excited to be with you on the podcast, excited to explain a little bit more about the newsletter, and happy to dive in deeper on any area that you want to go to.
Oh, you bet. Sounds great. So for the listeners who aren't among the 30,000 plus subscribers, and full disclosure, I just became one myself, so I guess it's 30,001 now. Could you tell us a little bit about what you cover in this FinTech Brain Food newsletter and what inspired you to start publishing it?
Yeah, so the newsletter covers everything from the hot trending topics and news of the day. For example, Adyen's share price just went down. And I don't just cover the news, I give my analysis as a nearly 20-year veteran in the industry from multiple perspectives and opinions and takes. I also cover recent things you might want to be able to read. And I finally cover 4 fintech companies that you might not have heard of in the past, as well as including just some random thoughts that are passing through my head I call a weekly rant. And people seem to enjoy the rant. That's like an essay form, but with way worse grammar. And it's been popular and it's done well. And the name FinTech Brain Food comes from the origin story itself, which during the pandemic, like a lot of people, I found myself with a lot more free time. And with this free time, one day I had a long drive. I was listening to a couple of podcasts. And those podcasts were so good, they were like food for my brain. And I wrote down some notes from those podcasts. And I also wrote down some notes from some fintech companies I'd seen. And I just posted it on LinkedIn one day. And it kind of took off. A few people said, God, that was good.
Nice.
Would you do that again? And so I did. I did it a second time for a second week. I shared my notes and I called it FinTech Brain Food. And that was popular. And people said, hey, would you do that again? And before I knew it, I'd done it 2 weeks in a row, 3 weeks, 4 weeks. So I kind of started by accident. And then I tried out this Substack thing so that people could just hit subscribe. And it took off. And now 32,000, nearly 33,000 subscribers. Everybody from VCs to CEOs of banks to CEOs of fintech companies and people just getting started in fintech and everything in between. So it's been a heck of a journey and really enjoyed it.
Great content marketing success story. Awesome to hear. So congrats on all that enthusiasm and growth around it. Can't wait to dig in. We wanted to ask you on this show, and maybe you'll be able to get us those kind of numbers after this episode. Ha ha ha. We wanted to ask you about after reading a recent issue where you talked about the changing nature of the relationship between traditional incumbent banks and fintechs. This has been a long time shifting, but what's the mood music there, in your opinion? What is that changing relationship, and what's causing it, and what should we take away from it in terms of the future outlook? And we can dig into a few other things there.
Yeah, so fintech was almost adversarial to some of the incumbent financial institutions, at least on the surface. That was the narrative for the past decade or so. Big companies like PayPal, like Chime, like Cash App from Square were seen as eating the lunch of the consumer business of retail banks and financial institutions. But what you see now is, especially during the pandemic, a lot of fintech companies that don't directly compete, companies that might provide digital onboarding, companies that might provide digital payment solutions, companies that might provide fraud prevention like Sardine are actually more like a pain pill than they are a kind of a headache. They solve problems for the financial institutions. Their first customer might have been Chime or Square or somebody else, but those financial institutions have started to see fintech companies as possible partners, possible ways to better manage their business and better engage their consumer. And so fintech is not the enemy. In fact, fintech is just part of the landscape on the consumer side, but fintech can be a great partner. And so I'm hearing this from CFOs, from CEOs. So the question now is, okay, great. These people, these fintech infrastructure companies, these fintech providers could potentially help me grow my revenue, engage my consumer, reduce my cost, maybe reduce my fraud too. So that's something I see every day.
Yeah, sounds like a harmonious opportunity. So what's the opportunity then for fintechs? Why would they want to sell to an incumbent if it involves things like buying committees, system integrations, and all these hoops that they have to jump through that they might not have to jump through if selling to smaller enterprises? What's the appeal of integrating into a larger, more established financial service or a banking service where they're really going to have to square a circle with some of the things that they do?
I think the number one reason is revenue certainty. In this market, there are a lot of fintech companies that have either gone under and a lot of customers that have gone under. So if you were going after the long tail of customers or businesses, then maybe that revenue growth has somewhat dwindled. But the revenue opportunity from incumbent financial institutions, they're less likely to go under, especially the large ones. That number two reason is they have an awful lot of volume. So if I sign one large financial institution, that might be 100 small or mid-sized fintech companies or e-commerce merchants and everything in between. So they're very, very big in terms of their volume. And number three is they tend to sign longer contracts. Given how hard it is to actually sign a contract in the first place, they don't want to be doing that every year. In a worst case scenario, they want to be doing it every 3, maybe even every 5. So if you can prove that you're enterprise ready, if you can pass all of the additional tests and checks, if you can prove that you can handle the enterprise scale and volume, and most of all, if you can understand the psychology of the incumbent as a buyer, that of course they're not stupid, that there is this assumption, I think, sometimes in the fintech world, but they just have different problems. They have different challenges. If you can understand that world, if you can demonstrate credibility, then you can get that revenue certainty, you can get that additional volume, and potentially you can put yourself in a great position with some great logos.
Yeah, makes sense. So on the flip side, isn't then there a lot of risk, or at least the perception of risk, for banks who are working with fintechs. I mean, startups that are looking to disrupt a sector are not really well known for paying attention to detail around things like regulation and compliance in some cases. So has that changed given the environment of the past few years and the learnings and the takeaways? For example, can you speak maybe also to, I don't know if you're familiar with the draft of PSD3 regulations. It might open up some banking license opportunities to fintechs and give more capabilities to fintechs in the future to really become banks themselves. First, address how do they perceive that risk, and then how are fintechs adapting to that environment of risk, and do you see hope or a better future on the horizon for fintechs being able to tackle all that risk themselves?
I think the short answer is yes. The sort of gauntlet that fintech companies have had to run to reach scale in the first place has taught a generation of people how to build and manage for risk at scale. So I think 10 years ago, you could have written off fintech companies as not really understanding. It's all technology. They don't really get regulation. They don't really get compliance. 10 years on, they've been doing it for a decade or more. They have tens of millions, if not hundreds of millions of customers in some cases. And they probably have better technology and they have people closer to the issue than some of the larger financial institutions. So in some cases, some fintech companies and the people within them have a depth of understanding of compliance that is at least comparable, if not in some cases better than I've seen in the financial institutions themselves. So let's give them the check mark for that. Now, not all fintech companies are created equal, but the ones that can stand out from the crowd absolutely have that depth of understanding. There are a number of people who've come either from the banking industry and set up a fintech company, so they had that knowledge baked in, or they've earned that knowledge through working for the past decade in the fintech industry. And what you get with that is a best of both. So in a large financial institution, yes, I might get compliance really well. Yes, I might get the fraud and the risk side of the world really well. But I don't always get to get my hands on with cutting edge tech. Whereas in the fintech world, yes, I get to have my hands on cutting edge technology, but I also have to understand fraud and compliance and risk in order to succeed. So fintech operators, fintech talent, fintech companies, the best ones have this best of both. They understand the cutting edge tech and they understand compliance. And that makes it a compelling proposition to work with a partner like a Sardine, like its competitors, as an organization, if you are going to be looking at dealing with the emerging threats like authorized push payment fraud, or dealing with better loan underwriting, or if you want to start looking at generative AI or whatever else, because that's been battle tested and hardened in fintech before it gets anywhere near the large financial institution. You mentioned sort of getting banking licenses. Outside the United States, there are lots of organizations that already have a banking license. I would point you to Starling and to Monzo and to Nubank and many, many others. These all have, if not millions of customers. In the case of Nubank, they have 84 million customers, run on cutting edge technology, and indeed are subject to all of the same regulations as any other bank. This is entirely possible. It's an accident of history that we don't already have this in the United States, and it's a matter of time.
Mm-hmm. Yeah. So I agree, this seems very appealing, but banks may or may not, certain banks may have their own internal innovation departments and want to do these things internally. What is the advantage of partnering with a fintech versus taking on these innovations within the organization? And why has it been a struggle in recent years to partner with startups and newer players, and seemingly, more of a better option for some banks, in their opinion, to sort of take the innovation from within versus from outside?
I think there's two questions. What should you do inside versus what should you buy or partner for? And then why is it so hard to buy from small companies? And I think let's start with that second thing. Why is it so hard to buy from small companies? Frankly, a lot of small companies aren't ready for a bank yet. A lot of small companies aren't capable, even if they were ready, of understanding the politics and the difficulty of getting inside that organization. The inverse is also true. A lot of large incumbents are just not set up to be able to buy from smaller companies. Their process is designed for buying from Oracle and IBM and Accenture. There are enterprises that only know how to buy, or for the most part, only buy from other large enterprises. And so everything is about expecting that enterprise to be ready for you and to know how your process works. Whereas a company that hasn't been through that as much maybe needs a little bit more handholding, maybe has different expectations, or maybe is doing something novel that doesn't fit inside your existing risk appetite. Just as one small example, banks have this idea internally, and a lot of corporates do, called a policy document. And a policy document says our rule about data retention is X. And another policy document might say our rules about data sharing are ABC. Now, a startup might come along with a really compelling idea and prospect, but it doesn't fit the wording of that policy document precisely. And so to get an exception to that policy can be incredibly difficult for the bank itself to do, no matter how much it wants to do it. And there are thousands of small examples like this where just getting the contract has this gauntlet that you have to run as a startup or as the buyer inside the bank that wants to buy from the startup. So there's a lot of challenges. And I talked about this on FinTech Brain Food on a blog called Partnerships with FinTech. So do check that out if you want more detail. I think the other part of the question, why would you build inside versus buy? Build inside works really well when you have all of the data you need and you have all of the expertise, and there's something unique about you that only you can build. One of the things we're seeing a lot of, for example, is some of the larger financial institutions building cutting edge machine learning and AI around trading. They're building cutting edge machine learning and trading around trading, cutting edge machine learning and AI around anti-money laundering, because those use cases tend to be specific to the bank, and it tends to require data that only the bank or the incumbent has access to. So the very largest do things by themselves. But why would you partner? Well, you partner with specialists who can do things that you can't. So in my day job at Sardine, we see an awful lot of data from non-bank transactions. We see things happening in crypto, we see things happening in e-commerce, and we've become really good at detecting scams before they happen. So we can do that in a way that maybe a financial institution couldn't. So the reality with this is often it's not an or, it's an and. You should work with specialists because they can add to what you can do. And you should really specialize in what only you can do. I think a lot of organizations don't have a clear feel for what those two things are, but partnerships can really help. And partnerships in particular, where a partner is ready for that. So can the partner share data? Do they recognize where they fit into your big picture? And were they designed to be one size fits nobody, or were they designed to be a lot more modular? And I think that's an approach that I've seen much more successful. So if you are a fintech provider and you're looking to fit into a larger financial institution's world, figure out what use case you can solve for them better than anybody on the planet and have the conversation around that use case. And you might find that you can end up doing a lot more with them.
Got it. Yeah, well said. And I just want to drill into some language from the newsletter that I mentioned earlier. So in this piece, you said that buying through a committee can lead to selecting the least worst product instead of the best. That's very choice language. So how can anyone selling, any of these fintechs selling to a big bank, not be perceived in that light and rather be perceived as, being the best versus the least worst? Why did you choose that language?
Yeah, if you are in a formal RFP process, then behind the scenes, there's typically a spreadsheet that scores everybody's solution based on price, based on performance, based on features. And a committee of people will put those things together. And the classic anecdote is a camel is a horse designed by committee, because it can go further, it can carry more water, but what they don't mention is it's really hard to use, and that you tend not to get the same results out of it. And so that can happen. The way to counter that is to make sure you know who the buyer is and that the buyer understands your value and that the RFP process is largely a formality to ensure that the organization has asked the right questions, to ensure that the organization has done its due diligence and has created a fair opportunity for other bidders, but that where it's seen the value, where you have the depth of relationships and contacts, and where you can provide the most unique value, you have the inside track, you have the depth of relationship, and you are best placed to solve that problem. And then you see the RFP long before it's built, and it's largely built around the unique capabilities of your product. And I think that way you can guide the outcome towards one that suits you.
Great. So, speaking from the experience of Sardine, there was an Ernst & Young survey that found that 40% of bank and fintech partnerships fail to operationalize. How can fintechs make sure that a sale turns into something that generates revenue for the banks? And what should they be doing to see that they actually get value out of these relationships, in your view?
Don't see getting a proof of concept and don't see getting a contract signed as success. Success is getting all the way there, and that might take 2 years. That might take even longer than that. I've heard it take 3 years. Don't assume that because you've sent your developer documentation to your API, that the client, that your financial institution knows what to do with that. They're going to need some handholding. They're going to need some white glove support and be ready to give that and be ready to react when they do. You cannot underdo the amount of support and attention these contracts get, because they will be worth it to you in the long run.
So, Simon, you're clearly bullish on the fintech as a sector, and you've said several times in your newsletter that fintech is just getting started. So, what do you think are the next areas we're likely to see disrupted in this space, and what impact do you think the evolving regulatory environment will have? Because we see it evolving on the global stage with global regulatory bodies, but also within governments.
So fintech has disrupted the low-hanging fruits. It's gone for consumer, it's gone for onboarding, it's really disrupted the experience. There's a lot more that can be done further into the stack. So as we get into corporates, as we get into international payments, as we start to think about lending to businesses, that's the next area for fintech companies to really go and disrupt. And then all of the providers in that stack will also rearrange. Regulatory changes vary by market, but I do expect that open banking in the United States, Dodd-Frank 1033, is really going to change that, as is the war on junk fees, as are many, many other regulations around the world designed to change that, like PSD3, which will make sure that companies can share data, that it will really look at the economics of the market and make sure that this is a little bit more balanced towards innovation. And I think we'll see many, many others follow that lead. So that's why I'm excited.
Great to hear. Well, thank you for sharing your insights today. Thanks for joining us. We love the newsletter. Keep it coming. And I'm an enthusiastic new subscriber, so I look forward to digging in myself. Hope to have you back sometime, Simon. Thanks for joining.
Thanks for having me. If the listeners want to subscribe, they can head to fintechbrainfood.com and I'll see you there.
Awesome.